So what I think will happen is there's a ton of companies that can acquire businesses for 100 to 500 million dollars. There's not so many who can acquire it for 2 billion or 5 billion. So if you're disciplined as an investor, if you're disciplined as a founder, and you're funding things at a 10 million, 20 million, 40 million, $60 million valuation over time, and not trying to pile all your money in at a $2 billion valuation, your universe of buyer outcomes is much bigger. And then the third category of exit, of course, is private equity firms. Right now, there definitely are private equity firms buying startups. They typically want to buy things that are at scale. So that's hard. Like if you're at 15 million in revenue and next year you're going to do 22 and the year after you're going to do 40, they just don't care. You're not big enough. So you have to be big enough to matter. You might have to do M&A to like consolidate yourself unless you can grow organically to get there. And right now they have, on a relative basis, more attractive opportunities in the public markets. Why? Because the private companies that raised a ton of money in 2021 and 2022, the valuations haven't been reset and the expectations of founders haven't been reset. So they're going in to talk to someone that they think they should buy at 4 times sales, who still believes they're worth 16 times sales. And so the spread is too big. But I suspect in 2 to 3 years, they'll get a lot more aggressive about buying startups.
Welcome to Sorcery. I'm Molly O'Shea, founder of Sorcery, a weekly top VC deals newsletter highlighting the top GPs, founders, and deal announcements leading the next innovation cycle. Today, we have Mark Suster, managing partner of Upfront Ventures. He's been there since 2007 and has led investments in companies like Invoca, Density, Nanit, and Maker Studios, acquired by Disney. And before that, he founded and sold 2 enterprise software companies, the latest is Salesforce. Upfront Ventures is an early stage and long-term partner to tech startups. They're based in Los Angeles and San Francisco and invests heavily in Southern California and in the US, Europe, India, and Israel. This is a really fun conversation, and I'm definitely biased because I worked at Upfront, but I hope you enjoy. Hi, Mark. How are you doing?
I'm doing wonderful, Molly. It's so nice to see you. I miss seeing you every day.
I know, me too. And I miss the seaweed snacks.
Yeah, we do have seaweed snacks. And every now and again, we change out and we introduce new snacks. So you got to stop by the office and check them out.
I will. I'll load up.
Yeah.
All right. Well, to start, I just want to kind of set the stage and make the audience aware that I am biased. I have worked with Mark before. I worked at Upfront Ventures. I'm a big fan.
I appreciate it.
That being said, I've also worked at other funds, so I'll be a little objective. I do think that Upfront has a wonderful management style, and the structure in which that you created at the fund was really fun to learn from. So that being said, I'd love to get into the structure of the fund and what it's like. So how do you manage, partner meetings to deal execution? And we can kind of start from there.
Okay. So first of all, you need to know, you do know, but your listeners need to know, we actually run 3 funds. And we run 3 fund strategies simultaneous. We have a seed program, we have what we call early growth, and we have a secondary program. Okay, so we do all 3 activities. Each of them are distinct, but they're all related. So let me cover what that means. Seed for us is about a $300 million fund, and we raise a fund every 3 years. And we've never gone faster than 3 years, Molly, and you of course know that. I think it's really important to have time diversity, and time diversity gives you 2 things in venture. Number one is you get like bull markets and you get correcting markets. So on balance, you're making sure your entire fund isn't deployed when valuations are high. So if you deployed your entire fund in 2021, I mean, good luck getting returns out of that fund. And just to tell you, 25% of all funds deployed their entire fund in 2021. 25%, 1 in 4. The median time to deploy in 2021 was 1.7 years. Okay. So what that means is most of your fund was deployed in 2021 and Maybe you caught the first half of 2022 when the market hadn't corrected. To contrast us, and I'm not saying we're great, we just have a strategy and we stick to it. Our fund will be a 3.5-year vintage. So we definitely invested in 2021. You don't get to sit out markets. You've got to be in markets, good and bad, in terms of pricing. So you have to be in every vintage, but we're not overweight 2021. We did just as many deals in 2023 as we did in 2021. So in that fund of $300 million, we do about 40 investments. Why 40? People say fund size is your strategy, or it determines strategy. If you have a $40 million fund, you're going to have one kind of strategy. If you have a $4 billion fund, you're going to have another kind of strategy. So at 300, our goal is to deploy up to 40 investments. And I can tell you empirically, we've been around for 28 years. Empirically, about 6 deals in any fund drive 80% of the returns. So when you write the first check, your assumption has to be this is going to be one of those 6 deals. Now, 34 out of 40 times you're wrong. But so a priori, you have to believe and fall in love with it. But over time, we find out where the high conviction deals are. An example that you would know from your time here, we invested in a company called Rula. When Rula was started, it was called Path. When Path was started, really, we funded Josh before he built anything. They were targeting alcoholism. And they were trying to build programs around alcoholism. And we love Josh. We love that market. We love, what he was trying to build and what he was trying to solve. And in fact, alcoholism is a much larger problem in America than Oxycontin or fentanyl. Like, you read about Oxycontin and fentanyl because they kill people in extreme fashions and very young people, and they are very destructive and destructive to communities. But alcoholism is much more pervasive, and I think a lot of us don't realize that. And functional alcoholics, as in drinking in the workplace, is also very, very common. And it crosses every industry. So that's where he started. And then he realized that's really a subsegment of the market I'm targeting. I really believe it's a downstream problem to dealing with mental health. So he shifted the business into providing mental health and a mental health platform. And that company has just been up and to the right since he made the shift. And a little bit of it was market needs, and a little bit of it was perfect timing going into COVID, where suddenly you didn't want to go to a doctor's office. And once you had virtual appointments, let's say it was your pediatrician or your general practitioner, you might have taken one remote telemedicine thing, but then the next time you go, you're going to go back in person because those are hands-on body type activities. Whereas mental health is 100% face-to-face, like virtual, no hands-on body diagnosis. And it turns out more than 70% of people prefer remote. So that business has been booming and growing. And I only mention it, Molly, as just an example, like alongside the 39 other checks we wrote in that fund, and that was a 2018 fund. It was a great founder and a great opportunity, but we just couldn't have known a priori. So about 6 deals do incredible. And that's our goal. And we are just very disciplined with what we do with that seed fund. Now, I'll just quickly say, because I know you'll want to ask more questions, the early growth vehicle, what's unique about us, that's a $200 million vehicle. It's very focused. It's not a $2 billion vehicle. And what we're looking to do is 2 things. One is 50% to back into our winners so that we're investing after we've already deployed 10 plus million from our seed fund, and we can write 20, 30, $40 million into their growth over time. And that's 50% of what we're doing. 50% of what we're doing is net new deals and hunting things in new categories, of which probably the place we've been most active is cybersecurity. And then secondary, so if you imagine this, a seed fund has a 10 to 12 year maturity, and it's really more like 15 years. And that's just the truth about venture capital. It takes longer for your fund to mature, and you might return your fund in year 7, 8, or 9, but you're yielding most of the profits in year 12, 13, 14, 15. Now, later stage growth typically is call it 7 to 9 year payback. So it's a faster payback. It still can get great returns, but it doesn't have the same upside potential as a seed fund. Secondary vehicles, we believe, will be 3 to 5 year paybacks, because where seed is investing in a de novo business, something, under 2 years old, early growth is investing later in the J curve when it's 6 to 8 years old. And secondary for us is investing in years 10 through 12. So you're really 3 years remaining. And that's our strategy. And sorry for filibustering.
No, that's great. We got the whole spectrum. To kind of just hone it in on the early stage fund. So let's say you do around 10 deals a year. Sometimes it fluctuates, right? Every partner maybe does 2 to 3. And then with the actual deal itself, they're pretty concentrated and you have a specific ownership, you have a specific size. Can you talk more about that and how you kind of
Yeah.
came to that?
Sure. I don't think there's one strategy fits all. There's different ways to do venture, and I don't want to say that our way is the right way. It's just what we've been doing for 28 years. It's worked, and we want to keep doing it and have a consistent strategy. There are some people that would like to do smaller checks with this size fund. They don't want to take board seats, and they want to have a wider top end of funnel. And their hope is, I don't know, maybe I deploy 750K or $1 million into the next Uber. Right. And so that's the strategy. And I can't say that's wrong. There's been amazing funds built with that strategy. And I don't want to say it's exactly their strategy, but that maybe the start of First Round Capital, the start of Founder Collective, like True Ventures. There were some firms that were just excellent at that, and their strategies have changed over time. Our strategy has always been high conviction, low number of deals, hunting in industries that we know, not just anything generically, but staying very focused in our swim lane of what we know. High conviction, join the board and be an active participant on the board for 10 to 12 years. And as you very well know, I have 2 boards that I'm on that I've been on for 13 years. So, right, like I'm deeply committed over the long haul. I have other boards I've been on for 8 years. And these are places that I know every twist and turn the business has been through over time, and hopefully can be helpful in that capacity. So that's our strategy. That's what we're looking to do.
Yeah. And when you get down to writing the check and doing the diligence, maybe reverse that, doing the diligence, writing the check, what exactly does conviction mean to you? How do you get to conviction, and what are your decision-making frameworks that you go through as you prospect each new company?
Well, the age-old question, is it founder or is it market? And whatever anyone says, who knows if they really know which percentages it is of each. But I would say we are more slightly founder-centric than market focused. Centric is the word I was looking for. And the reason is that extremely talented founders like Josh Bruno at Path will figure out on their own that they weren't quite targeting the perfect market opportunity, and they will make the adjustment. If you're in the perfect market opportunity and the founder isn't quite perfect, you're going to have, it's because most markets are winner take most. Number one takes the majority, number two takes the rest, and number three is a set of steak knives. And if you back 3, 4, 5, you're just not going to make a lot of money. You need extreme success in the category. And so that's why we're probably like 70% founder. If it's a founder targeting a market we just don't believe in, we won't write the check.
Yeah. Yeah. And are there certain positive signals that you like to see in founders? Because I know, we get a whole host of personalities and expertise and all of that good stuff, but what are like the main positive signals you find?
Well, so I think we talk about 3 things at Upfront. We talk about product market fit, and what do we mean by that? Because it's a term everybody throws out. We're investing long before product market fit. Sometimes we're investing before product's even been launched in market. So by definition, it can't be product market fit. But we have to understand something about the unit economics of the business. Is it going to dramatically lower the cost? Is it going to dramatically make something more efficient? Is it going to improve convenience a great deal to customers? Is there some industry change that we expect to happen that this is going to lead to this company being more successful going forward? So we're looking for that. Like we have to be able to explain to ourselves why we believe this is going to be big. The second bucket is founder market fit. And that matters a lot to us. And the example I sometimes give is in 2008, I met two young guys out of Harvard, and they were guys, and they were launching something in the mom space. And I'm like, you're 22. Like, what do you know about breastfeeding? What do you know about colicky babies? What do you know about what moms go through? Like, it's just not authentic. And of course, that's an extreme example. It happens to be a real example, but it's an extreme example. We're looking for, like, what is your raison d'etre? Why are you doing this? Why are you mission driven? So, Eden at Pragma, the founder of Pragma, which is video game infrastructure, and they're trying to automate back-end video game infrastructure the same way that, say, Unity or Unreal Engine did for the front end of video game design. They're doing it for back end of video game design and operations. And he had worked in the sector his whole career. He knew the sector incredibly well. And his co-founder came out of Riot Games here in LA. So when they came out with the thesis and his founder had built something similar at Riot Games, we thought to ourselves, okay, incredible founder market fit. If you look, again, not to pick on Josh Bruno, but if you look at Josh, you know, his background, he had built a healthcare company number one. Then you look at a company called Bionaut. Bionaut's a company we backed in LA. It does micro robotic surgeries on the stem of your brain. I just toured it yesterday. It's so phenomenal, Molly. Like I went and viewed like their entire facility. But you know, the founder, he is a double E and a PhD in robotics and has all the right skills to bring to bear to solve this problem. The first company he was head of technology or CTO at was incredibly successful and sold to Apple. The founder of that business doesn't really need to work. And what the two of them decided is what they wanted to do with the next phase of their careers is do something meaningful that could really make a difference in the world. And so that's why they started Bionaut. So the second bucket is very long explanation to a short question is founder market fit. When you see someone who's just extraordinarily driven to solve that problem. And then the third thing we look for is founder upfront fit. And we're not for everybody and not everybody's for us. And that's okay. There's lots of VCs out there, just like there's lots of founders out there. But we're looking for people who want to make this their career. They're not looking for, hey, I could get into this market. It's going to be super hot. Maybe I'll get bought in 3 to 5 years and then figure out my next thing. We're looking for someone who almost, if they got that call in years 3 to 5, would say no. I mean, again, I'll just take a cliche, like when Yahoo offers to buy Mark Zuckerberg for $1 billion, like how many people do you know in those shoes who would have said no to that? Not many, right? $1 billion at the time, even like maybe $1 billion is not what it once was, but it was a lot of money. Like companies weren't getting bought for $1 billion. And he said no, he was driven by it. Or you know, Evan Spiegel at Snapchat, who could have sold for $1 billion out of the gate, just decided he wanted to do his own thing. So we're looking for people with that kind of drive.
Yeah, that's really helpful. And that's a good perspective. The 3 pillars for conviction.
Yes.
Okay, so I guess like going back to upfront strategy, while I was there, you were operating with the barbell strategy. Are you still operating with the barbell strategy? And can you explain that? What are
Yes,
the
I will
market
explain
dynamics
it.
that create that?
I will explain it, and yes, we are. So barbell meaning if you imagine a barbell that you might lift, then it's got 2 weights on either side and a thin bar in between them. So we invest at seed stage, and we're typically writing a $3.5 million check. We can write 2, we can write 5, but let's say the median check is somewhere between 3.2 to 3.5, depending on the vintage. And then we don't do a lot of A and B investments. I'd say almost 0. Now, that doesn't mean we don't follow on. We will follow on and do our pro rata, but we're not entering at the A or B round. And we have a very specific reason why, which is the market for A and B between 2010 and 2022 went up by 9x. So 9 times more capital in those markets than in any other sector of the market. And as a result, valuations went up like 300%. And you got priced out, because if you had a $2 billion fund, let's say 2 funds ago, they were $300 million and they were writing $5 million checks. Now they raised $2 billion and they want to write $25 million checks. And you can't write a $25 million check at a 15 pre, and take the majority of the company. So you end up paying 60 pre. And so I think that A round is the single most overvalued round in venture capital. Now, it just so happens that if you're managing $2 billion and you're doing your own math on how many top of funnel risks you're going to take, you can afford to pay higher prices than I can pay at my $300 million stage.
Yeah, and I actually just read a Carta report today. I don't know if you saw it, but the graduation rate from seed to Series A is now at an all-time low. And before, it was like in a normal year, they'd say like 20 to 25% graduation rate. Now it's at 13. And that's
It's not surprising. It's not surprising. Like, capital can be more picky and wait to see what's actually working. So a little bit less competition in 2024 than there was before. I would say that the benefit of working with someone like Upfront is, if you work with a $300 million fund, writing a $3 million check into your company at the seed stage, it's very easy for us to write the follow-on check ourselves if you haven't hit the milestone. We don't guarantee it, but we pretty close to guarantee it. Like, it very, very rarely happens that we won't do a follow-on round. So if we wrote a $3 million check, the next check might be 3 million, it might be 5 million, it might be 750K, but it's almost never zero. So what you get is a more patient investor that's going to allow you to turn over more cards, as long as we still have conviction in you. Even if we've lost a little bit conviction for the market, we probably would tell you we've lost conviction for the market. But if we wrote 3, would we write 750K or $1 million to give you a chance to try and reposition your business to something more attractive? Almost every time.
Yeah. Yeah. And that was like one piece. I know, like, I feel silly asking most of these questions because I know the answers.
Yeah, it's okay, but the people listening don't.
But this is where we are. And like, another thing that I walked away from when having the experience there was the integrity that the firm had with backing their founders throughout time. Things go up, they go down, but integrity was always there. And even during the SVB crisis, you were like, I'm happy to pick up the line and support the team in case we can't have access to capital ourselves and help fund your salaries. And I thought that was amazing. And so there are like some instances in there that I was considering, okay, well, like, Upfront has great integrity, and that carries on through many different functions of how the fund operates, whether it's from backing founders through their Series A, showing support checks, backing the team, all of that stuff. And it's wonderful.
I do want to say, I appreciate you saying all that, and that is kind of how we feel. That's how we try to recruit people that also think the same way. But that isn't the same thing as being a cheerleader. And I think there are too many cheerleader VCs. So as you know, like, we take boards almost every time we invest, not every time, but almost every time. And so you get the founder who sends out an update to the board, sometimes to extended group of investors. And you get the kind of VC that will say, great job, in the email and copy everybody. We're not a great job VC. Like, either I'm not going to respond because for whatever reason the email didn't require a response, or I'm going to respond with a point of view on something. I'm not going to waste everyone's time. So at board meetings, like, I just had a board meeting today. I picked up the phone and called the founder right after the call. And I said, here's 3 topics I just want to cover real quickly. It wasn't appropriate at the board meeting in front of everyone, but I want you to think about A, B, and C. I view it as our job to, like, be a sparring partner, and it's lonely being CEO. I was CEO twice. It's very lonely, and you don't get a lot of advice. And when you get advice, most of it is not applicable. And so I view it as our job to have an opinion and to state that opinion, but then to step back and say, you may disagree, you run with your playbook, but just know that this is an alternate view, mix it in with everything else you're considering.
Yeah, you're definitely not one to shy away from sharing your opinion. You're direct. And so like I'm just curious, what did you learn in your time period as a founder that made you understand that that was very valuable and important to share with other founders and have that directness and share, objective points of view or
Well,
opinions?
listen, I found being CEO very lonely. And I found it a lot less glamorous than people imagine. So you imagine you raise $5 million, you're in the press, everybody's talking about you, your parents call you, they're so proud of you, your siblings are calling, like everyone is telling you you're going to be successful. But you know that raising capital isn't success. And so then suddenly you're trying to get your product out the door, the product is late, you finally ship it, and you get it in front of customers, and some like it and some are complaining. And then I don't know, someone uh, tries to hack into your system, and now you're having to deal with intrusion detection, something you didn't even know about the year before, and you're having to figure out what intrusion detection is. Or some customer is publicly complaining about your product, whether what they're saying is accurate or not. You're like, okay, now I have to deal with um, how I deal with public communication when someone's saying something that's not true. I can't just come out and attack them. That never looks good. So, like, you're just overwhelmed with decisions to make without any real experience of what to do. And then you hear boards talk, and you often get input from investors who have never done what you've done before. And so it's like well meaning, smart people saying smart things, but it's not actionable. Um, and so having done the job twice over a 10-year period of time, like I try to go in and say, look, I know the world's different. Maybe my playbook isn't relevant to you, but this is what I learned, and let me see if I can be helpful.
Good perspective. Um, and I guess to just take a step back and talk more macro. Okay, so we talked about the fund, we talked about the fund structure, how you make decisions, gain conviction. I'd love to understand more about where we are in the market and how the fund is seeing things, how you're seeing things, what your perspective is. Obviously there's massively overvaluated AI companies running amok. There's a lot of really fun stuff happening in LA with the hard tech community. Let's start from a category standpoint and let's talk about what are the categories that are really thriving right now or showing more light or more opportunity, and then we can go from there.
As a start, I always tell people that to make money as an investor in any category, venture capital is just a sub segment of being an investor. You have to believe in something that other people don't. Because if everybody believes it, it's priced in, there's no upside. So there's no such thing as investing in what everyone else is investing in and making money. I mean, you could theoretically, but that's called luck. Okay. So it's our job to invest in something that we believe is going to happen in 5 years and being correct. If it's going to happen in a year, you probably missed the trend, and there's probably 10 other VCs that were investing 4 years ago. And if you invest in something that's going to be big in 10 years, you probably are going to run out of capital at that startup before it succeeds. So there's an old saying, which is being too early is the same as being wrong. And I'd say often we as investors are too early. We often know a lot of the right trends and we're just too early. So market timing is incredibly important. So often what we're talking about is not what the market talks about, and therefore we come across looking strange. So 7.5 years ago, when we met Michael Spiegelmacher from Bionaut, and we had a belief that two belief sets. One is that we felt there was going to be a merger between technology and healthcare in a way that you could get mass devices created more cheaply and more accessible in ways that hadn't been used in procedures before. So we started looking at examples of that. And then also looking at places where IT itself could play a bigger role in healthcare companies. And we have two very big companies now doing that. Not a lot of people were talking about healthcare 7, 8 years ago because it was seen that healthcare is a regulated industry. that moves too slowly, that has complicated set of buyers, that is not a big adopter of technology, or at least at scale in a uniform way. There's too much custom that's done. And so I think we had a good category to ourselves. We started doing ag tech, agriculture technology. That's become a lot more common in the last 3 or 4 years. We started in 2014. We had LPs saying it was strange. So you asked me a very specific question, is what are we looking at now? The things that interest us the most now, space. Because Falcon 9 by SpaceX has reduced the cost per kilogram by 90% to launching payload into space, there's a lot of opportunities opening up in space, and they're not rocket propulsion. We're not funding businesses to compete with SpaceX. That ship has sailed, so to speak. But there's a lot of interesting stuff happening in space. We just announced that we were investors in Apex, which is a satellite bus company, and it's reducing the cost of a satellite from about $30 million to about $6 million per satellite, and they will continue to drive the cost down. And they're increasing the frequency and cadence of how quickly they can create buses by standardizing, and there's never been a standard bus for satellites. And then we're doing a lot more national defense. That can cross into cybersecurity. It can cross into computer vision inspection. It can cross into actual physical hardware devices. And then last is we're looking a lot more at ships and shipbuilding and the shipping industry. It's something that, again, not a lot of VCs are talking about. But when you look at where all the dollars are going to go 5 to 10 years from now, we believe in the following. Number one, we believe in declining demographics. So smaller populations, to get productivity out of smaller populations, you've got to be investing in robotics and AI to improve productivity. And so we're doing that, but we're just doing it in sectors that we know better and that we think we can have an influence over our investment decisions. So that's one trend. The second trend is deglobalization, because deglobalization is causing people to think about, how do I create more ships? How do I create more cybersecurity? How do I create my own sustainable food production? We think a lot about climate. And we're not necessarily investing in reducing carbon from the atmosphere, but what impact does climate have on fire? And what investments can we do to help with fire? What markets will emerge? Even things like insurance markets. We invested in a company to help insurance for floodwaters, as an example. And then shipbuilding plays into that, both because you have the deglobalization conflict. So, the Houthis are shooting boats that are coming through the Gulf of Aden and up through the Red Sea, causing more ships to go around the Cape of Good Hope, which adds $1 million per shipload and about 2 to 3 weeks of extra delivery, which means you need more ships. And then you're going to need ability to protect ships where there's more conflict between countries. So as we sit here in June of 2024, there's an increasing conflict between China and the Philippines. And there's a lot more conflict that you're going to see. I know one of the things you wanted to ask me was about books. If you read any of Peter Zeihan's books, he talks a lot about this in Disunited Nations. Actually, it was in The Absent Superpower. He wrote a book called The Absent Superpower. He started talking about something called the tanker wars. And I'm like, what the fuck is the tanker wars? Like, I don't even understand what you're talking about. And so he showed the movement of oil around the planet. So China, Japan, Korea, and Taiwan are highly, highly dependent on oil imports. The United States is not. So we don't have the same problem that they have. So almost all of their oil comes from the Middle East. It goes up and around through India, and it arrives at Singapore. It goes through a place called the Straits of Malacca, which is a 200-mile long channel that if someone shut down the Straits of Malacca, they'd shut down the world economy. So that's one thing that you need to protect in terms of shipping. And then they dump it at oil repositories in Singapore, and then it gets picked up by a tanker in Singapore from their oil repository and brought up around through Asia. Now, if you're, I don't know, Japan, and China blocks that oil from being imported or blocks the ships from getting through, what do you do? So he was basically saying there's going to be increase in tension between all the major nations who need access to that oil to survive. So anyway, so we think a lot more about national defense and shipbuilding and things like that.
Just to challenge you on that a little bit, Mark.
Mm-hmm.
Those are categories that are traditionally capital intensive.
Mm-hmm.
I listened to your episode on Apex, and I thought that was
Yeah.
great. I thought you provided a really good example and reasoning behind why you're still doing it and how you debunk these misconceptions. So I'd love to hear more about, maybe it's specifically with Apex and space, but what are the main misconceptions about these categories that are now being unraveled?
So if you assume that you're operating a hardware business that requires CapEx, that let's say it's 50% profit margin, just to pick a random number, and let's say your product is $10 million. So it's $5 million for you to actually produce it, $5 million in gross margin, okay? If that 5 million, so your sales price is 10 million. If I get 20% down from a customer, if I'm producing something they really need that they can't get from other places, and they put 20% down, I'm covering 2 out of 5. So I'm covering 40% of my CapEx with a down payment before I start even buying materials. Then you can do stage gate payments. So you have milestones, and when I hit the milestones, you have to make another 10%, another 10%. So you can find yourself in a world in which you've shipped a product that has very limited CapEx risk, not zero, but limited CapEx risk, as long as you're meeting the deliveries that you set forth for yourself. In the case of some hardware products that I'm seeing, you have to invest 10, 15, $20 million in setting up manufacturing in the first place. That's a large capital outlay. But the size contracts that they're talking about are $100+ million. So in what category, selling t-shirts and socks, are you going to get to $100 million in orders in a year or two? So it's at a different scale, and you can actually use scale to an advantage because there aren't going to be that many people that can make those kind of investments to yield the kind of contracts that people can yield if you're successful. So you look recently at Anduril, probably the most important company in the private markets behind SpaceX. Incredibly large CapEx to get into the game, but once you're into the game, you're able to win massive contracts. And most people won't succeed, but I don't think CapEx itself is a limiter to being involved in industries. And as I always tell people, like, so many people are afraid of hardware. If I tried to sell you a product on your iPhone, download it and pay $20 a month, it's so hard to get someone to pay $20 a month for anything on their iPhone. If I sell you a $200 piece of hardware, but then you need a $20 a month subscription, it's very easy to get someone to pay for the subscription. For whatever reason, cognitively, once we're willing to pay for hardware, the subscription we're willing to pay. So Oura Ring, Whoop, 8 Sleep, Peloton, you name it. Now, I'm not saying all of those companies are going to succeed, but I always challenge people to say, like, Apple, one of the most successful companies in the world, maybe second or third most successful in the world right now, at least by market cap, largely drives its profit through having hardware. Their profit itself doesn't come from the hardware. I mean, they get a lot of profit from the hardware, but the lock-in that they've created, the App Store's delivering 90+% gross margin, incredibly profitable business from the App Store. If you look at Google, Google also produces hardware products to protect their leadership. If you look at Amazon produces or buys hardware products like the Ring camera, which we were an investor in, to protect the markets that they're in. But even look at NVIDIA, like the world's most valuable business right now is a hardware business. So I think VCs just got a little too comfortable that every investment they were going to do was software only. And I just don't think that's realistic for the future.
From the investment standpoint and the investor seat, being in the glimmer of really sky high software valuation multiples is also a draw. In hard tech, are the multiples that large? Like, what are you seeing? What are market?
Well, let's at least demystify software. Okay. So people were paying in 2021 25 times next 12-month revenue. Okay. Over the last 10 years, they were paying just under 10 times. So let's say it's just under 10 times. That is building in an assumption that you are going to continue to have nonlinear growth, that maybe you're growing 80% year over year. And if you're growing 80% year over year, it doesn't matter if someone pays 10x because you're going to grow into your profits. But the 20-year average is 6x. And right now, if you're growing at 20%, you're probably trading at 4x. Okay, so it's not as crazy valuable as people thought. Now, why people are so interested in SaaS is as long as you add high net dollar retention, if you went out and got 100 million in revenue or 50 million in revenue, and you had really high recurring revenue, then you could count on cash flows that would last for a series of years. Now, we went through about a 10-year period where everyone was trading client server for SaaS. And as they traded client server for SaaS, every category in SaaS grew. I'm not sure we're in that world going forward. I think you're going to see a lot more consolidation of platforms for the enterprise buyers. And of course, the software companies are going to use AI to improve their margins, their operating margins, and that's going to help with some of the companies. But again, I just think it was unique to the last 10 or 15 years, and it may or may not apply to the next 10 or 15.
On the exit standpoint, I know that you've talked about this a couple of times, but the window to IPO and exit has elongated a lot, and now we're getting to a PE-ification. Very hard. I don't know why I just said that, but
Yeah.
of the market. And so there's a lot of restructurings that are happening, or they're just being private longer or going away. So what are you seeing in terms of exit opportunities for companies?
Well, first of all, what I would say is that IPO is what everybody used to want. And it was like when I was younger as a CEO, your dream was to IPO. But the structure of the market was very different back then. You had a whole industry, you had investment bank analysts that would cover small cap companies, they would do analysis on small cap companies. You could be in the market and have coverage and have investor base that cared about you. But over the last 20 years, you have more automated trading. You have more mass dollars moving to the biggest investments, building index funds. And the investment banks that used to cover small caps don't exist anymore. So you have almost no analyst coverage. It's just not cost effective for them to do so. So if you go public and you have no analyst coverage and you don't have institutional investors looking to pile into your company, how does someone discover that your shitty little company exists from a stock perspective? Unless you just happen to keep growing really strongly. And even if you read the analyst reports, like go look at any tiny little company that does its quarterly filings, and you go read the analyst reports, and they're just AI bots writing stupid articles that say nothing because no one's covering it. So going public, if you don't have coverage and you don't have an institutional base that wants to invest in you, like, is worse than being private, because you now have a fixed market cap that doesn't go up. You don't really have liquidity. Like I look at some of these stocks, they trade $50,000 a day. So imagine you own $80 million of a stock that trades $50,000 a day. And if you try to trade 200,000 in a single day, you drive the price down 20%. So you really have to be enormously successful, I believe, to take a company public in 2024. Maybe that'll change over time. I'm not so sure. I know other people believe it will, but I'm not so sure. I hope it does, but I haven't seen evidence of it yet. The second category is selling to strategic buyers. And of course, that's a great outcome if Google, Facebook, Amazon, NVIDIA, whoever can buy your company. Awesome. The problem is that at least in the current administration, the FTC has not been looking too kindly on these mega deals. And so I think the mega deals just aren't going to happen for a period of time. I don't know what will happen post-November, but even either administration, I'm not convinced they're suddenly going to open the floodgates for M&A. So what I think will happen is there's a ton of companies that can acquire businesses for $100 to $500 million. There's not so many who can acquire it for $2 billion or $5 billion. So if you're disciplined as an investor, if you're disciplined as a founder, and you're funding things at a 10 million, 20 million, 40 million, $60 million valuation over time, and not trying to pile all your money in at a $2 billion valuation, your universe of buyer outcomes is much bigger. And then the third category of exit, of course, is private equity firms. Right now, there definitely are private equity firms buying startups. They typically want to buy things that are at scale. So that's hard. Like if you're at 15 million in revenue and next year you're going to do 22 and the year after you're going to do 40, they just don't care. You're not big enough. So you have to be big enough to matter. You might have to do M&A to like consolidate yourself unless you can grow organically to get there. And right now they have, on a relative basis, more attractive opportunities in the public markets. Why? Because the private companies that raised a ton of money in 2021 and 2022, the valuations haven't been reset and the expectations of founders haven't been reset. So they're going in to talk to someone that they think they should buy at 4 times sales, who still believes they're worth 16 times sales. And so the spread is too big. But I suspect in 2 to 3 years, they'll get a lot more aggressive about buying startups.
Yeah, that's valuable. So I know we're running up on time and we'll close it out with some fun things.
Okay.
Mark, I've noticed throughout this conversation, you've changed your name like 5 times. I don't know if that's like on purpose. First it was Mark runs the world, then
exactly.
It was Mark the shark, now it's Mark in the dark. What do we got next?
I'm just having a bit of fun with what is this, Riverside? Is that what you recorded?
Yeah, this is Riverside.
It's I have ADHD, so like I can't talk and not type at the same time.
It's great. I want to know what each one of these personas is.
There you
okay.
go. How about if I stick with that one?
Mark with ADHD. Okay, let's go.
Mm-hmm.
So you already like half answered this question earlier, but I wanted to get a book recommendation from you. You're a really big book reader. Carrie's a big book reader. Everyone there is very studious and into literature.
We read very different things, though.
Yeah.
She considers everything I read too boring, and I consider everything she reads too literary. So here's some book recommendations. The book I'm currently reading is called Freedom Forge.
Okay.
And it won't really focus. It's called Freedom Forge, How American Business Produced Victory in World War II. So we tell ourselves all sorts of myths about the tech sector. One myth we tell ourselves is we never get government support and we never sell to military. Anyone who knows anything about Silicon Valley knows that it was really financed by the DoD, and that most technology, starting back with chips, were serving dual use, serving government, and then that led to a commercial industry, and it was large government contracts. So what this book is, it's the story of the people who built the infrastructure that made America successful from about 1900 to about 1940. So it profiles a guy named Bill Knudsen, and Bill was working for Henry Ford and helped Henry Ford improve his production of the Model T. And they had a big falling out. And then he went and joined a failing company called General Motors. and General Motors was a shit show. And there was a gentleman named Alfred Sloan who was brought in to turn it around. Alfred hired him to revitalize General Motors, and he launched a brand new car called the Chevrolet. It never existed before. He launched it in, I can't remember, like the early 1920s. Maybe it was even it was the late 1920s. And over a period of like 5 or 6 years, it became the best-selling car in America, overtook Ford, and GM became a bigger company than Ford. So you have this guy, and then the second guy that they profile is, I can't remember his first name, but I know his last name is Kaiser. And he's the guy who figured out how to build the road system in the United States. As you had more car production, you needed more roads, and there weren't a lot of people skilled at doing that. So it talks about how he built roads across Oregon, Washington, California, eventually built the Hoover Dam. So these became the great titans of infrastructure that created competitiveness for America. And then World War II happened. And FDR tapped these titans of industry to step in and help the United States figure out how to ramp up its war production. So Freedom Forge, How American Business Produced Victory in World War II, which is something people often don't say, which is your ability to manufacture, your ability to produce products can determine success or failure of countries. And I would argue that's why companies like Anduril are so important, because the future battleground are going to require a new type of weapon, a new type of defense system, that if we don't develop it, the Russians will, the Chinese will, the Koreans will. And I'm just really grateful that both people and companies like that exist. I think entrepreneurs in 2024 are way more patriotic than they've ever been. And, there's sort of a pride in helping America and capitalism. So that's great. That's a book. The second book related to that is called Chip Wars. And Chip Wars tells the history of the chip industry, and it tells some of the stories that I was talking about. But the origins of chips in the Vietnam War, we dropped a bunch of bombs on Vietnam that were dumb. And they were just like killing civilians and blowing up needless stuff and not hitting their target. And a group of people in Silicon Valley figured out that using a chip, you could create a precision guided munition and actually strike the bridge that you were trying to strike and not people. And by developing precision guided munitions, we were able to save lives, meet our strategic objectives, but it really changed the balance of power between us and Russia and it talks a lot about capitalism and risk taking, and why capitalism and risk taking always produces a better outcome than command and control economies. So for anyone who's despondent that thinks China is going to take over the world, I just encourage you to read books like that, because I think I'm incredibly long America. And then the third book is called The End of the World. The End of the World is it's about deglobalization. It's not about the world actually ending. It's about deglobalization. It's written by Peter Zeihan. Yeah. He's written 4 books: The Accidental Superpower, The Absent Superpower, Disunited Nations, and The End of the World. And they all talk about geopolitics and demographics and how that is deterministic about how the world itself is organized. So anytime you start to think you understand how the world works, unless you understand demographics, geography, natural resources, how people defend themselves, you don't really have a sophisticated understanding or model of how the world will evolve. And he's very good at breaking that down with data. So those are some books you might enjoy.
Those are fascinating. I read the last one already, and I remember the first chapter of that book. I was like, oh my gosh. I woke up early on a Sunday morning. I was like, I'll just, I'll read this. It'll be nice and light. And it was definitely not light.
It's not a Sunday morning read.
No. It was great.
I do have one more book recommendation. I wanted to make sure that I also covered this. I highly recommend this book. I just want to make sure I get the title right. I'm pretty sure I will. Yes, it's really simple. It's just called Israel.
Okay.
And it's written by Noah Tishby. Mm-hmm. Noah is a left-wing Israeli, okay, not a right-wing Israeli, a left-wing Israeli who moved to the United States She was a film producer, and she's a media entertainment executive. And she started to realize just how much bias there was in understanding what actually happened in the land of Israel. So if you're anyone who's not Jewish who doesn't naturally know this, and if you consider yourself an unbiased person, of course, anyone who writes history writes from their own perspective. But if you want to read someone who writes a wonderful account of what it was like growing up in Israel from parents who got away from the pogroms and Jews being killed in Europe and helped settle Israel, and what was it like when they settled it? How many Arabs were there? Did they have good relations or bad relations? What happened in 1948? How and why did the country separate? How has it been managed since? She spent time in the West Bank. She spent time with Arab populations. And she tells a very human story with a lot of facts on what's it like on the ground in Israel. And I just highly recommend it to everyone, because if you're getting your news from TikTok and you've never spent time in Israel, and you're being influenced from Twitter, from people talking about things like genocide, which of course isn't happening. If you're talking about, I always say people who throw out terms like apartheid, okay? So of the almost 10 million people that live in Israel, 2.1 million are Arab Muslims who are citizens, not the West Bank, that's separate. In Israel, they are Arab Israelis, those 2.1 million. I'm not saying that it every day feels as good, like, because you don't control the country, you're a minority, and anytime you're a minority, you're fighting to get your fair share of the voice. But they are elected to government. They can serve. They can run hospitals, be doctors. They're citizens with equal rights. And so people throw out terms without knowing what they're talking about, things like apartheid. And then they talk about mass movement of people. So there were, I think at the time, I might be off by a little bit, but approximately 800,000 Arabs living in Judea and Samaria. Judea and Samaria, Jews have lived there for 3,500 years. So to put it into perspective, that's 1,500 years before Christ. And I'm sure you know Christ was Jewish. He was Jewish because he lived in Nazareth, which was part of Judea and Samaria. And Islam was created in the 7th century. So you're talking about people who were tied to this land for 2,000 years before other people were there. They were, of course, many of them forced out. Some stayed, but they were forced out by people like the Romans, who came in and killed Jews and spread them to the diaspora. There were 13 tribes of Israelis that left. And Zionism is simply a belief in the legal right for Jews to buy land in the land of their heritage and return home. So around the time of 1948, when the United Nations recognized the state of Israel and a separate right for Palestinians to have their own land, there was a war. And something like 700,000 Arabs left. I think 154-ish thousand stayed. That 154,000 became 2.1 million. So if you want to call something a genocide, the Jews are pretty bad at genocide if that's the case. Meantime, the Jews were driven out of Tunisia, Algeria, Iran, Iraq, Morocco. Like, Jews don't live in any of the Arab countries anymore, and there's like 40 or 100 people, not even in the thousands. And it's just, people have to have context, and this book will set that context. So I'm sorry to go on and on, but you asked me short questions and I give you long answers.
No, it's fascinating. And I love the theme of history throughout all your book recommendations and learning from the past to understand future structures and have empathy for the world around us.
I appreciate it.
Well, Mark, it was a pleasure having you on, and I can't wait to see you next when I'm in LA.
Please come see me.
All right. Bye.
All right. Take care.